Hello, Accounting 230, course number 42139. This is our Saturday 3 in the afternoon class, which apparently nobody wants to attend. So I'll do my best to lecture on chapter 8, and that will complete the trilogy of chapters 6, 7, and 8, which will be the subject of your next midterm exam. And on Canvas tomorrow, you will see what I think is a pretty good review of those 3 chapters I did last semester or the semester before. So that'll be up there. And of course, each chapter video is also up on Canvas and on my famous Bob Smagula YouTube channel, which is hard to say without giggling, to be honest with you. So let's see if we can get started here. We have a very busy little chapter here. We have a chapter on depreciation, amortization, and depletion. And I'm trusting that you see the slides as I see them. And I'm going to go through this in a certain amount of detail. And hopefully you go through this little lecture and you will end up with a good basic understanding that'll get you going to do your homework and exercises. And then I know you'll study properly and get ready for the midterm exam. So here we go. Long-lived assets, otherwise known as fixed assets, right? Fixed assets. These are the ones that will be around for many years, we hope. Actively used in the operation, and we benefit from them, don't we? We buy a machine that packages our product. Well, we get benefit every time we wrap up a box of clothes or something. Okay, so you have the tangible items, the items you can touch, the machinery, the cars, the land, the building, the fixtures, the furniture. You get the idea. And then we're going to talk about 2 intangible. You can't see them, you can't touch them, but they're there. They're just like Santa Claus. They are there. And what we're talking about there are the intellectual properties, goodwill, for example, trademarks, patents, copyrights, things like that. And we're going to go over rules for handling these different types of items. So let's see what we have here. We have the long-lived stuff. I don't like that long-lived. Let's call them fixed asset. Land, subject to land is an item. That's obviously a fixed asset. And then you have assets subject to depreciation. And that's any other fixed asset except for land. Land does not depreciate. That's a gap rule you need to understand and be prepared for maybe a true false question on the test. Land is not depreciated. Every other fixed asset is. Every other, tangible fixed asset can be depreciated. You also have natural resources which are depleted, like a gold mine or an oil well or a forest. So natural resources like water, things like that, are subject to depletion, not depreciation. And then the third part is the intangible set of items. These items, like patents, trademarks, franchises, if you open up a McDonald's, trademarks, goodwill, these are amortized. So let's understand. Fixed assets, the big ticket items you can touch and see, are depreciated. Natural resources are depleted, and intangible assets are amortized. So armed with that, let's take a look at the balance sheet here, section of it, huh? Southwest Airlines. Well, they have flight equipment. They have ground equipment. I guess the flight equipment would be the planes, and the ground equipment might be the taxis, the guys loading your baggage on and off the plane. And then they got some deposits down on contracts. And then they have some assets that they constructed themselves, and that can create a fixed asset. So you add them all down, your total asset, fixed asset, is 22 million I think it's actually in this, I think the number here is actually 22 billion, to be honest with you. In fact, I know it is. That's 22 billion, 22 million is, and forgive me with the happy fingers here. Less accumulated depreciation gives you the net book value. They're calling it total property and equipment. Let's call it net book value, okay? And then they had goodwill, and they might have some other assets. Measuring and recording the acquisition cost. This is an important thing. I worked most of my career in factories. I was always the controller at manufacturing operations. And we did this a lot, where we would buy a big piece of equipment, and the cost of the item, the debit, say, to machinery, is not just the purchase price. Acquisition costs include the purchase price and all other related expenses to get this thing going. It doesn't include financing charges. Borrowing money has nothing to do with the amount that we're paying. So, purchase price. If it was a sales taxable item, that just becomes part of the debit to the machine. If we had to pay a truck driver or have special delivery of some kind, those freight costs would be included. If it was maybe a land deal or a building, you have to pay your lawyers and realty guys to make that happen. And installation costs, and that was a big one where I worked. We would occasionally have to buy a piece of machinery that we couldn't fit into the building, believe it or not. And we had to either knock part of the wall down, which is what we did actually, or disassemble the machine and put it back together again. We were not smart enough to do that, so we knocked the wall down. So the point is, you have other costs involved in your debit to machinery or building, huh? And they're giving you some more examples here. Equipment, you buy the equipment, you might need to knock a wall down to get it in. You might have to pay an electrician to hook it up to a special outlet. You maybe have to modify the building, like we just said. The freight cost, equipment, buildings, you're going to have a lot of legal fees, and you may buy the land for $1 million, but you might have to spend another $1 million cleaning it up. Maybe there's some environmental issues that need to be resolved. All of that becomes the cost of the building and the land. Same thing, real estate, title issues, delinquent taxes. Hopefully all of you will, one of these days, not to do it in the future, be in a position where you can buy a house, get a mortgage, and you'll learn about these things the hard way, okay? Measuring and recording acquisition cost. Well, we're going to start with kind of an easy one, it looks like. Kind of an easy one. What are they saying here? Southwest Airline purchased a plane for $75 million in cash. 75 million cash. They're also saying they also bought an aircraft with only $1 million in cash. And Boeing was nice enough to take a note from us. Okay. So we have two different situations here. We buy it for cash and we make a down payment and take out a note. Let's see what we've got going here. Well, that's not too tough, huh? We debited airplanes or flight equipment, whatever it might be, and we credited cash. Now they bought it for $1 million cash and 74 million in a note. I don't know why this thing is repeating. I find it rather annoying. Okay, here we go. Flight equipment, cash. And when we ordered this plane from Boeing, we said to Boeing, we can't pay you 75 million right now. We don't have that kind of money. You trust us to pay you? And Boeing said, yeah, you have to sign a note though. So that means this might be a 10-year note. In 10 years, we have to pay back the 74 million. And in the meantime, make annual interest payments to Boeing. You can buy something without cash. Who knew, huh? Who knew? Record at the current market value of the consideration. You know, here they're giving them stock in the company. Southwest is giving away part of their company in the form of a special stock issue to Boeing. You know, Southwest maybe could have given them some old planes and they would call that a deal. And Boeing would take those old planes and maybe restore them and put them back in service. So the consideration, meaning what was the item of value that was exchanged, can be almost anything. So again, we're still going to debit flight equipment for $75 million, huh? And we're going to credit cash. In this case, they're saying that they gave them 25,000 cash, as well as 1 million shares of par value stock at a value of $50 per share. Now, we should know from our well, we haven't gotten there yet. We're in chapter 8. Okay, but we did talk about this, I think. The common stock line on your balance sheet is always going to be the par value multiplied by the outstanding shares. So that's what we have here. 1 million common stock, the difference of 49 million is additional paid in capital. All right, so continuing along, we can also build it ourselves. Forgive me if I digress into one of my stories. It's all about me, right? But I think you find this interesting. October 1st, 1987, our factory was preparing to take its annual physical inventory. I had worked all night to help set things up, make sure that the accounting records were cut off correctly. And 10 minutes or so into that 7 a.m. start, Los Angeles was hit with a devastating earthquake, the Whittier Narrows earthquake, and our building was condemned. Our building was ruined. Fortunately, no one was killed or hurt at our place. We all did manage to get out, but it's quite a sight to see your building shaking around you. And what I'm getting at here is corporate back in New Jersey said, okay, you guys, we're going to finance you guys in a new building. And they left it up to us to buy the building and get that building set up the way we wanted. So here is an example where, yeah, we got a building, but then we had to do everything else in terms of getting the machinery up and going, a reasonable amount of the overhead, the interest, acquisition by construction. Here is an important thing to understand. I don't think it's a difficult concept, but it's nice to have this under your belt for some good, easy multiple choice questions, huh? The difference between a repair or maintenance and an improvement. Let's start with an improvement. This is a major overhaul or partial replacement. You don't do it very often, and it increases the efficiency of the fixed asset and maybe provide a longer lifespan. Maybe you did something to take a machine that had a 10-year life and now it's going to have a 15-year life. And it's typically large amounts of money, okay? So think in terms of a car for you car people out there. You buy a 1965 Mustang and you bring that thing home and then you really soup it up. You put in a whole new, even more powerful engine. You rebuild the chassis. You take that car and you turn it into a monster. That would be an improvement. Okay? Now, that same car requires ordinary repairs and maintenance, maintains normal operation activity, doesn't improve the productivity. But if you don't do it, the thing will fall apart. Doesn't extend the life. It occurs over and over, small amounts. An improvement is capitalized. It goes on to the balance sheet. So if you had a machine and you debited machines for 100,000 and then you put a $50,000 improvement on it, you now debit that machine for another $50,000. And you may even change the depreciation schedules on it, okay? A major improvements, major, go on the balance sheet. Not an expense because you're going to get that benefit over a long period of time. A repair is an expense. Getting back to that fancy Mustang, well, you got to change the oil once in a while. You got to change the filters. You got to rotate the tires. That is all normal. Normal, ordinary expenses goes on the income statement, okay? Normal expenses to keep up, in this case, a car, all right? You got to change the water in the windshield wash, everything. And they're giving you another look here. I don't particularly like this grid, but we'll look at it. Repairs and maintenance again versus improvements. To capitalize something means you're putting it on the balance sheet. And the expense is deferred, meaning it comes later when we do what? Yes, somebody said it right. When you depreciate the asset. That's when you get it on the income statement. And so if you capitalize something, you're going to have higher income because it's not an expense, and your taxes are going to be higher. So what companies can do if they want to be wise guys, I mean, I never saw this because I don't think it's that easy to do, is pretend that everything is a capitalizable item, and thus you don't pay, and thus let me say it the other way, please. You pretend that some of these capitalizations are really ordinary repairs, thus reducing your income and paying less capital without any cash problems. Now don't get me started on the many bankruptcies and frauds that were committed in the late 90s. Enron is the most obvious example. Adelphia Cable TV was a Ponzi scheme. Bernie Madoff was a guy from New York who managed to somehow cheat people out of $65 billion before they knew they were robbed. The biggest fleecing in world history. WorldCom was another one of these bums. These guys were down in Mississippi. So look at one of the scams they tried to pull. When expenditures that should have been recorded as current period expenses are improperly capitalized as part of the cost of the asset, the effects on the financial statements can be enormous. Of course it is. $1 million that you put as an expense or capital when it should belong to one or the other, terrible. In one of the largest accounting frauds, WorldCom inflated its income and cash flows by billions of dollars. What they did was they capitalized almost $4 billion of operating expenses. You know those oil changes? They all went onto the balance sheet. And this house of cards eventually went down, and the president, the CEO was placed. Ebers, I believe his name was Ebers, another Bernie. He had Bernie Madoff, and he had this guy, Bernie Ebers. Bernie Madoff is in jail for the rest of his life, and this guy is too, I believe. Okay, now we're going to talk about how you depreciate assets. And we already learned about, I believe we did, we learned about straight line depreciation, but perhaps not. Yeah, we certainly did when we did the adjusting entries, right? Depreciation concepts. Depreciation is a cost allocation process that systematically and rationally matches acquisition costs with the periods benefited by that use. You bought a machine for $1 million, and that machine is going to last you 5 years. You're getting the benefit of $200,000 out of that machine every year for 5 years in the form of depreciation expense, a debited depreciation expense, and as you know, a credit to the contra account, because you never credit the fixed asset until we get to the end of this chapter, when we're going to talk about selling and disposals. By the way, systematically and rationally is a gap term that has some specific meaning. You have to demonstrate that you have systematically and rationally matched these things up. For example, you buy a $10 million machine today, and you're looking at your outlook for the fiscal year, and you say to yourself, well, we're going to end up with a profit of $10 million. So that's going to cost us at least $3 million in taxes. And somebody said, oh, I have an idea. Let's depreciate this $10 million machine in 1 year. Cannot do that. That's not systematic and rational. So here we go. Depreciation expense goes on the income statement, of course, and accumulated depreciation, which is a contra asset, meaning it is an asset that has a normal credit balance that becomes a reduction on the balance sheet. Okay, since we don't credit the asset itself, we are crediting its counterpart, the contra. Remember, all contra accounts are married to somebody. In this case, the accumulated depreciation is in a marriage with the original cost of the asset. We continue. Understand depreciation is a process of allocation, has nothing to do with the market value of the asset. Let's understand that. Let's understand that. Again, I'm going back to my wonderful world again. We had part of what we did was we had a little printing area in the factory, and we had this old lead type machine, terribly old fashioned. It was depreciated probably 40 years before I started working there, 40 years ago. And my point is, we would get phone calls once in a while for people wanting to buy that lead type machine as a valuable antique. And we eventually did sell it for some pretty good money. But the book value on our general ledger was zero. In those days, before you had Photoshop and you had all these wonderful individual computer apps and programs, we used that machine maybe once a month for Hollywood. We would print out wanted posters that looked like they were published back in the days of the cowboys. So, and the remaining balance sheet amount, nothing to do with market value. And the undepreciated cost is not measured on a fair value method, okay? Okay, let's start looking at some journal entries. And adjusting journal entries needed at the end of each period, each month, to reflect the use of the buildings and equipment. And that use is called depreciation. And they're repeating that balance sheet portion we saw earlier, okay? Now, what do we need to do in order to depreciate an asset? Well, I think you know this already from chapter 4. We need to know what we paid for it. We have to know what the useful life is. And we know we have to take into consideration the residual value. 3 methods we're going to learn here. There are other methods as well. We're not going to go over them in this chapter. I wish we went over one other one I used to like called the sum of the digits method, where never mind, I'll talk about that later. We actually use sum of the digits method. Anyway, alternative depreciation, you can choose straight line, units of production method, which is similar to what we're going to do with depletion, and an accelerated method called declining balance. Can you promise me this? Will you promise me that you'll call that double declining balance? Put a double in front of that. Double declining balance. Very important, and we'll get to the reason why. DDB, double declining balance. Okay, we're going to start off with the straight line method. And we should already know this. We buy something at cost. In this case, it was $62,500. They bought some of those ground trap trailers that run around the runway, bringing your baggage back and forth. So they bought some of this stuff for $62,500. It had a residual value of $2,500, meaning we think at the end of 3 years, someone will give us $2,500 to take it off our hands. Well, we should know by now we don't appreciate the residual. So the depreciable amount is going to be $60,000 divided by 3 years. Holy cow. I'm right. It came out to $20,000 a year. You can look at this on your own later. They're just pointing out different airlines, different lives on their planes. Straight line depreciation. I like how they threw that in there all of a sudden, huh? $20,000 a year. So get used to this grid here. Get used to the fact that this upper right number, that first number, will include the residual value, regardless of the method. You start off with the residual value. That doesn't mean we're going to depreciate it. Under straight line, we're depreciating $20,000 a year. So here's our journal entry. You debit depreciation expense, you credit accumulated depreciation, which is that contra asset. And at the end of this year, the balance in accumulated depreciation is 20, and the book value of the asset has now gone down by that same amount to 42.5. Let's look at the finished product. Well, we know each month the entry is the same. Straight line, the easy method. Debit expense, credit accumulated depreciation. Notice that the balance in the accumulated depreciation contra asset has gone up by 20,000 each year, while the book value has gone down by 20,000. You notice that balance at the end there? That's the residual value. Residual. You can never bring the book value, regardless of what method you're using, you can never bring the book value on your balance sheet below the residual value. Once you hit the residual value, no more depreciation. So I think we were pretty good with straight line. I wouldn't expect that to be much of an issue. So let's go to the units of production method. And we're learning two things at once now when we go through this. We're learning units of production method for a fixed asset and also for depletion, because it's the same exact thing, okay? Well, let's look at our rules. Once again, we are going to exclude the residual value. Exclude the residual value. So we're going to have a depreciable amount of 60, but we're going to start our chart with the original cost of 62.5. Okay, so let's see what they're telling us here. At the beginning of the year, Southwest purchased 62.5. Look at this. They're telling us that they expect to get 100,000 miles out of that asset. They expect to get 100,000 miles out of that asset. What is the depreciable amount of this asset? 60,000, right? $60,000 divided by 100,000 miles tells us they are going to depreciate this item at the rate of 60 cents per mile. So take a moment and look at this. Not terribly hard, but you're seeing it for the first time. So naturally, it's a bit counterintuitive. Our second depreciation method, units of production. 60,000 divided by the anticipated miles. Keep in mind that depreciation is based on estimates, systematically and rationally computed. So we bought this car, let's assume it's some kind of car, and every time we drive that car 1 mile, we're going to debit depreciation expense for 60 cents. Okay, so the month ends, and in year one, our saleswoman, she has a company car. She drives all around the Southwest. She's driving up and down the mountains and deserts. 60 cents a mile, 0.6, 6 times 3 is 18. Debit depreciation expense, accumulated depreciation, 44,500. Okay, let's finish this up. They're showing you the calculation. Okay, 60 miles, 60 cents a mile. That's our estimated depreciation expense per mile times the miles driven. Okay. They're repeating that again, but now they're also completing the grid here. So the second year, she drove 50,000 miles. 5 times 6 is 30. 2 times 6 is 12. There is your debit to depreciation expense, your credit to accumulated depreciation. The book value went down by 18 to 44. Then it went down by 30 to 14. And then it went down by 12 to 2,500. At that point, we're done depreciating the car. Now, she may have taken good care of this car, and they might actually get 150,000 miles out of it. But those last 50,000 cannot be depreciated because we've reached the net book value. Okay, here's one that has a little bit of a twist to it. It has one rule we need to understand. Accelerated depreciation. Accelerated depreciation matches higher depreciation expense with higher revenues in the early year of an asset's life when the asset is more efficient. Boy, that's a mouthful. What they're saying is this is an opportunity for companies to front load much of the depreciation expense in the early years and show very little depreciation expense at the end of the years. So, for example, depreciation expense, the machine is working great. All right, we can justify charging more depreciation. We don't have as many repairs. But as the machine ages, the repair expense is going to go up and the efficiency of that machine probably is going to go down. Doesn't mean that's actually going to happen, but that's the assumption we're allowed to use in rationalizing this method. It is called the double declining balance. Remember I warned you about that? Double declining balance, because the rate we're going to use is going to be, I'll hold that off for just a second. The rate we're going to use is going to be double straight line. So if you have an asset that straight line would have been 5 years, 1/5. Let's multiply 1/5 by 2, and you get 2/5 or 40%. So let's take a look at this here. Under this method, and this is the important thing, this method, you do depreciate the 62,500. You do depreciate that number to do your calculation, not the 60,000. That's one exception here. At the beginning of the year, they bought equipment. It has a useful life of 3 years. 1/3, right? 1/3. Double declining balance. 1/3. What is 1/3 times 2? Guess what? It's 2/3. So earlier, when this was straight line, it was 20,000 a year. Now we're going to take the entire original net book value, the original book value of that thing when we brought it in. We're going to ignore the residual value. So look at this. How about that? We are depreciating 2/3 of the book value every month. So 62.5 times 0.666, whatever, gives you a huge 41,677 the first year. So we reduce the book value by that. The next year, we only have a balance, it looks like, of about 17,000, 16,000. We multiply it out. You can see how it goes down every year. And companies may opt to do this for different reasons. So let's look at our grid. Here we go. 62,500. Double declining balance. It would have been 1/3. Multiply 2/3. It multiplied it by 2, it comes out to 2/3. 62.5 minus that depreciation expense gives you 2833. 2833 times 0.67 gives you this, and it brings the book value down to 6944. 6944 times 2/3 is 4629, which brings the book value down to 2315. We have a problem, don't we? Because the book value can never go below 2,500. So we have to step on this number and put the number here that will get us down to 2,500. And it will be 6944 minus 2,500. So let's take a peek here. I wish they showed it in a little more detail. Yeah, okay, they did. I'm so sorry, guys. there's the 4629. We can't use that number. We have to change that to this number, 4444. And how did we get that number? It's simply the prior year's ending book value minus the residual value. So you can see the double declining balance method makes you think a little bit. You have to really remember that it's double whatever the straight line rate would have been, and that you include the residual number in the depreciable amount. And depending on how long you're depreciating this asset, you could very easily go below the net book value, at which point alarms should go off and you adjust. Okay. I'm skipping that. We're not going to talk about this too much. Increased profitability due to accounting adjustment. Financial analysts are interested in changing in the accounting methods because they can have a big impact. And earlier, we briefly looked at that Singapore Airlines has a useful life of 10 to 15 years. It had estimated the useful life, they had increased from 10 to 15. So what that did was reduce future depreciation expense by $265 million. Now, Singapore Airlines is a darn big company. It's 265 million, though. It was still a pretty nice chunk that represents an incremental change in your net income. Investors want to know these things, okay? Tax reporting, we're not going to do much with this. One set is prepared. In fact, I'm going to skip this. I'm guaranteeing you right now, you have the Bob's Magula, New Jersey guarantee. This won't be on the test. If you really want to learn about all these tax implications, and it's a very interesting, big world, I recommend Barbara Aue's, Professor Barbara Aue's tax class that she runs, I believe, 1 or perhaps 2 semesters a year. She's a very active CPA with a large tax practice, and she does all kinds of tax work, corporate, individual partnerships, and her course is quite great, I've heard. And I'm going to digress. I hope I'm not repeating myself, but a friend of mine is a CPA with a firm here in Santa Barbara. And he told me that when they hire from, say, UCLA or USC or UCSB or Westmont, the first thing they do with their new hires is they send them down to City College to take Barbara's tax class. They think that much of it, okay? Here we go. An impairment to an asset. Well, if an asset suddenly is not doing us any good, either because it broke down, the machine blew up, we didn't maintain it properly, we didn't make those oil changes, well, that machine no longer has value. It's impaired. It's impaired. Or the machine is obsolete. It means that this thing doesn't do what it should anymore for us. The market has changed. And here's the big one, really. Lack of demand for the asset, okay? 20 years ago, I'm making this up now. 20 years ago, a company spent millions of dollars for a machine that stamped out VCRs, and business was good until the world of the DVD was far superior. So now this particular company, hypothetical, this hypothetical company is now stuck with a machine that works perfectly. They can make VCRs better than anybody in the world, but nobody's buying VCRs anymore. So that's one of the reasons an asset could be impaired, okay? And it also might mean we're going to try to get rid of the asset in the middle of its depreciable life. Disposals of property, plant, and equipment. Well, we may choose voluntarily to sell the asset. We're going to sell one asset because we're buying one to replace it, or we're going to trade it in or retire it. All of these things require a journal entry. Fire could damage it, accidents, vandalism, storms, right? So we have to get into the world of recognizing that loss when the impairment takes place. Now we're going to talk about disposals of property, plant, and equipment. And I'll try to make this as easy and clear as I might, okay? We have to get rid of an asset. So what we have to do is make sure we've recorded all of the depreciation expense up to the day we're getting rid of it, okay? They're describing the journal entry. Well, we're probably going to get cash for it. We debit cash, and we also have to debit the accumulated depreciation. We have to do that because we have to get rid of the net book value. So we're going to debit cash. We're going to debit the accumulated depreciation, so the contra asset is now gone. But we also have to credit the original cost of the asset. The original cost of the asset minus the accumulated depreciation at the time of the disposal is the net book value. And any difference between these debit columns will be either a gain or a loss. So let's take a look here. Let's take a look. Here's a quick, easy way to start. If the cash you receive is more than the book value, you have a gain. If the cash is below the book value, you have a loss. And if the cash equals the book value, you broke even. Not so hard. So let's take a look at one here. And I think this is a pretty good question. Southwest Airlines sold flight equipment for $5 million at the end of its 17th year of use, okay? 17 years. It originally cost $20 million, and they used straight line depreciation, and it had a life of 20 years. So they were depreciating that machine at the rate of $1 million per year. So what was the net book value after 17 years? 20 million minus 17 million. That's the net book value. So let's look at a couple journal entries. The net book value, what did we say it was? It was 3 million. How much did they sell it for? 5 million. If the answer is not C, a gain of 2 million, then I really... Oh, thank God, that's not what they were asking. They weren't asking for the gain. They wanted to know the depreciation expense for the 17th year, okay? I thought I didn't read it. I thought they were asking for the gain, okay? So we know that the depreciation expense is 1 million a year. So times 17, our book value becomes 3 million. We understand that? Net book value, we bought this asset for 20 million, depreciated at 17, and on January 1st, at the beginning of the 18th year, we sold it for $5 million. So here was my answer before. Do you agree it's a gain of 2 million? Thank God. Sometimes I get egg on my face here. The gain was 5 million. We sold it for 5, book value 3, 2 million. Now I'm going to take you into the journal entry and give you another suggestion on how to digest the disposal of a fixed asset. Let's prepare the journal entry for the sale. Okay, so let's think about it. We got cash of 5 million, or whatever, 5 million, right? We know we're going to debit cash. We know we're going to debit the accumulated depreciation of 17. And we know we're going to credit the original cost of 20 million, leaving a gain of 2 million. So let's take a peek at this. We sold an asset that had a book value of 3 million for 5. There you go. Now I'm going to show you maybe an even easier way to approach this. If you don't want to mess around with figuring out what the gain was, you don't even have to figure out the gain. You can still do the journal entry. As long as you remember this template. Every single disposal, without exception, is going to give you the same 4 accounts. You know you're debiting cash. You know you're debiting the accumulated depreciation. You know you're crediting the original cost of the asset, the purchase cost. At that point, you say to yourself, let's see, we got 22 million here, 20 here. I guess it was a gain of 2 million. When you plug the figure on the credit side, that's a gain. Disposals of fixed assets. When I was in the classroom, I used to tease my classes because they seemed to get real confused at first. And I would tell them at the end of the class, you should pray this is on the test because it's always the same 4 accounts. Okay, let's talk about depletion. Depletion, natural resources. Depletion is the same thing as the units of production method we just learned earlier in this lecture, okay? Acquisition and depletion of natural resources. Well, you're extracting something from the environment like an oil well, and the total cost of that asset is all the cost of drilling and exploring and developing and buying the land, paying geologists to study the land, anything it took to get that oil well ready to produce. These kind of assets are, of course, non-current assets. We don't call these fixed assets, call them non-current assets, and they are going to be presented at a loss less accumulated depreciation. Hey, we don't have accumulated depreciation. If it's a natural resource, it's accumulated depletion, and we're going to allocate by the units of production method, okay? The units of production method. So let's see what kind of stuff we're talking about here. Let's take a look. The acquisition and development cost minus the residual value gives us the number of, divided by the number of estimated units, it's going to give us our number. So we spent $25 million to develop this oil well, and now we know there's oil down there. Oh, this is wonderful. And we know we're going to get a certain amount of units out of that. Well, we're going to divide that into this calculation. So the depletion cost for a particular period is going to be whatever this rate is times the number of units extracted. In this case, I believe we're talking about an oil well, okay? So we record the depletion cost, and that's going to go into our inventory, and the units we have not sold will end up in the inventory, and the units we did sell will be in the cost of goods sold. I wish they gave us a little more on this, but go back to the portion of the chapter regarding units of production method. This oil well is going to produce 1 million units. We're going to get 1 million barrels of oil out of this oil well, 1 billion. But it cost us $10 billion to get the thing up and running, even after we take out the residual. So 10 billion in cost divided by 1 billion is $10 per barrel. At the end of the month, we extracted 2 barrels. We multiply, it's $20 of depletion, okay? And we're getting toward the end here. He's got a couple more things to review. The acquisition and amortization of intangible assets. Intangible assets. Non-current assets without physical substance. You can't see them, huh? Sometimes the life is hard to determine. And if we can't do that, we're not going to amortize it. And these assets have value because they provide exclusive rights or privileges to whoever has legal ownership of this intangible asset, usually acquired for operational use. I guess what they're telling us is companies will always be looking to get a patent to sell their product or a trademark or something. And you record these assets at the equivalent cost, and that can include purchase price of it, plus legal fees, filing fees, search fees. So let's go through this here. In order to amortize something, you amortize over the shorter of the economic life or the legal life, subject to GAAP, okay? Subject to GAAP. In other words, you purchased a patent, and a patent has a 20-year life. But that asset, is only going to last you 10 years. So you can only amortize it for 10 years. That's all we're saying. And it's always straight line. So depletion, the oil well, and this are pretty simple. No accelerated methods. If you can't amortize it, if you don't know life, you can't amortize. And you're always testing for impairment. Make sure that it's still a valuable asset. Like I said, that patent to produce VCRs was proudly hung in the factory office 30 years ago. 10 years later, it had no value. And then you have to reduce it. And amortization is a cost allocation process similar to depreciation and depletion. You need to know you depreciate tangible items, you deplete natural resources, and you amortize the unknowable, the intangible, okay? Let's talk about something called goodwill. We got to do some goodwill hunting, if you know that movie, huh? Goodwill. This is an intangible asset. It occurs when one company buys another company, and only purchased goodwill is an intangible asset, okay? So it arises when one company buys another, and here's where the goodwill comes from. It's the amount by which the purchase price exceeds the fair market value of net assets. Notice it does not say the cost of the assets, the fair value. Here is an example now where we sold our company today, and we had a piece of land that we bought 40 years ago near the beach, and we paid back then $50,000, and we could barely pay it off, but we did. And the value of that land has gone up. It's now worth $10 million. As you know, you cannot write up the value of an asset. You can only write it down immediately under the GAAP principle of conservatism, meaning if an asset an asset went down in value, you have to record it at the lower of cost or market, taking us back to chapter 7, okay? So here's what we have. I guess I'm going off on a bit of a tangent here. So that land is on our books for $50,000. When they bought it, they're not going to debit their new balance sheet for 50. They're going to debit it for 10 million because that's what it's worth. And that's the key with the goodwill. You're restating the purchased company's balance sheet. It is not amortized. Goodwill is not amortized. It used to be. Its value needs to be reviewed annually for possible impairment. In other words, if the value of the company would start to go down, and the book value is reduced if impaired. And they're going to give us a little calculation here, okay? So let's take a look. Our PEC paid $2 million to purchase UTEC's assets and liabilities, okay? So UTEC, this company here, they had assets and assumed liabilities of $400,000. But look what RPEC says, well, you may be carrying those assets at 400,000. We're not going to do that. We're going to put it down at 1.8 because we know that's the market value, and that's going to become the basis for our calculation. We know we have to pick up the liabilities. So in our view, your company is worth market-wise 1.8 million minus 4. So we're paying 2 million for a company that's worth 1.4 million. So let's talk about that. What would be the goodwill? 600,000. How did we get that? We bought RPEC and we paid 2 million. At that point, we don't even look at their balance sheet because we're going to debit every one of their assets now at the fair market value. And what you're mostly talking about are the fixed assets. In other words, RPEC had $50,000 in cash. Well, we're going to debit 50,000 in cash. That's not going to change. Accounts receivable is not going to change. The inventory might, but probably not, because that's a current asset. That price is probably good. But the long-term assets, those are the ones that have grown in value a great amount. So we're going to say that we bought a company with 1.8 million in assets minus 400,000. That means that we think the market is 1,400,000. That's the equity. That's the equity. We think this company really is worth, market-wise. But we had to pay 2 million. Why did we have to pay more than the 1.4? So the difference between the 1.4 and the 2 is, of course, our 600,000 goodwill. And why'd they pay more? Well, I'll tell you why. The reasons can be many. The guy who runs this company, he said, I don't want 1.4 million, I want 2 million. And you say to him, but it's only worth 1.4. He says, I don't care what it's worth. You can't have my company unless you give me 2 million. RPEC wanted this company so badly. They were willing to pay that 600,000 because they knew, or they felt, that if they could take this company under their control, get a shot at UTEC's customers, tweak UTEC's system, that they could turn this $1.4 million company pretty quickly into maybe a $3 million company. Okay? Goodwill. Now, I'm going to point something else out. Well, I'll do it when we get there with patents, which is right here. Amortization of intangible assets. Trademark, a symbol or design like you see here, an exclusive right to use a name. Trademarks. Copyrights. This is interesting. Copyrights. Books, magazines, published material to the public. The exclusive right to publish, use, and sell a literary, musical, or artistic work. Okay? I write a book and I get a copyright. That means that only I can benefit from selling that book. If someone else prints that book and tries to sell it, they're committing a crime. I will sue them and, get my rights back and collect from them. And this is kind of it. The legal life is the life of the creator plus 70 years. So I don't know if any of you are going to inherit a copyright from somebody. Maybe you will. But after the deceased passes away, you've got 70 years of revenue from here. And you amortize over the cost of the period benefited, okay? So 2 examples of intangibles. Now let's talk about patents, because this is the one that we're really interested in. Patents. A patent is an exclusive right granted by the United States government to sell or manufacture an invention. Right now, this country is enduring the worst pandemic in its nation's history. It's officially worse than the 1919 Spanish flu, which killed hundreds of thousands of Americans. This is going to be much, much worse. And as you know, drug companies are doing everything they can to speed up the production of an effective vaccine. And it looks like, thank God, there are two very promising ones on the horizon. One is from Pfizer and one is from a company called Moderna. Let's talk Pfizer. Pfizer has invented this vaccine, and they're about to apply for a patent from the United States government. And the United States government looks it over and says, yep, we agree, you can have this patent, okay? You can have this patent. That means that Pfizer, excuse me, okay, I have to confess, I'm watching the UCLA game. Pfizer gets the patent. So they get that patent and they hang it up in their office and they proudly look at it. But they don't put it on their balance sheet. They don't put it on the income statement. Isn't that interesting? Why wouldn't they? Well, the reason that they can't amortize that patent is because all the research that they've done over the last number of years to develop this product and perfect it was charged off to research and development expense. So in a way, they got a big tax break because all the equipment they bought to test this, all of the raw materials and inventory items, they all went to research and development expense. So they don't amortize it. Now, here's the part that we need to know. Pfizer invented this product. They may or may not choose to make it themselves. If they make it themselves, they have the patent and there's no accounting to be done. But Pfizer may say, you know, we're pretty good at inventing products, but we're not very good at marketing them or selling them or distributing them. We don't want to put up with the hassles of collecting money from customers. So they may do what many, many, many inventors do. They will sell the patent, and they sold it to your company. They sold the patent to you. At that point, you will debit patent and you will credit cash. Now you are the one who can amortize it. This is a long-winded way of saying only the purchaser of a patent gets to amortize it, okay? Now, if you bought this asset, if they sold you this patent, as soon as they got it from the government, you'll be able to amortize it over 20 years. But since a patent has a legal life of only 20, if they sold it to you after the 4th year, you can only amortize it for the remaining 16 years. Research and development cost is what I was saying. That might result in a patent. They're normally expensed as incurred. So at least they got a tax break on that. If they spend $20 million developing the product, well, they save $6 million in taxes roughly. And technology is another asset. Intellectual property includes the company's website. Another word for technology, intellectual property. And how about a couple more before we call it quits here? Franchises, legally protected right purchased by a franchisee to sell products or provide services for a specific service. And this purchase price is an intangible asset. If any of you know about McDonald's, it's the classic franchise operation. McDonald's says, okay, if you want to open up the McDonald's up here on the Mesa, up on Cliff Drive and by the 7-Eleven there, you have to pay us a franchise fee. You have to pay a franchise fee to McDonald's. It could be a big number. Let's just make up a number. It could be $100,000, okay? But what do you get for that $100,000? You get the name of McDonald's behind your store. You get the purchasing power of a big Fortune 500 company like McDonald's. You get their advertising benefits. So that's what you're buying with a franchise. licenses and operating rights. I don't want to get into this. Bill Gates invented, Microsoft apps. He can license them out and say, you guys can sell as many as you want. I don't want to bother. I'll just collect these licensing fees or royalties, okay? And I don't think this is too hard to understand. What happens here? Depreciation and amortization have a positive cash flow. Obviously, right? when we get to 3 more chapters now, we're going to have a whole section on just cash flows. Depreciation and amortization are a lovely thing for companies because you save taxes on it. You have an expense of, say, $10,000, but that didn't cost you any cash. But you were allowed to reduce your income by that amount, so you save taxes. Gain on a sale, effect on cash flows. Now, why are they showing that negative? Am I missing something here? Why is a gain on it? Yes. In fact, I'm not sure I want to go over this and try to explain. I mean, I can't do it, believe me. The reason the gain is a minus is you have to take it out of the beginning net income. And you guys don't even know that yet. We haven't gotten that far with the cash flow statement. Believe me, it starts with net income, and you add back the non-cash expenses, and you subtract out these extraordinary non-operating gains and losses. So if you had a gain, you take it out. If you had a loss, you have to add it back to get up to a cash basis. And I would suggest you ignore this tape at this point for the last 2 minutes or so. Loss during an impairment. Let's not worry about this. That is definitely getting way ahead of the class. Now, I am going to take us into the supplement to finish up here, because you should know this, or at least have it in the back of your mind, okay? I sure hope some of you get out in the workforce and you're dealing in an accounting office, maybe not as an accountant, but as a sales manager, perhaps, or purchasing, or an officer of the company or a manager of some kind. Assets, estimates can be changed. We bought an asset and we said the useful life is 10 years. And this is the estimated residual value. But these estimates can change over time. If the estimates change, the book value less any residual value at the date of the change is depreciated over the remaining useful life. Wow, what a mouthful, huh? What a mouthful. So let's take a look here. We'll finish this chapter up. Southwest purchased an aircraft for $60 million. Depreciated straight line of 20. Boy, we've seen this all day today, huh? In year five, they changed the estimated life from 20 to 25. And they changed the residual value from 3 million to 2.4. Your assignment, if you choose to accept it, calculate the depreciation expense for the 5th year using straight line. Now that seems pretty complicated, huh? Let me see if I can divide and conquer for us, huh? Here is your template. We'll go right into this. I'm just going to repeat this one more time. They purchased the asset for 60, right? So we know the asset cost 60. We know they were depreciating it at a rate of $2,850,000 per year. And we know that gives us the remaining book value. We're going to subtract the new residual. And here it is. Let's take a look. I appreciate you hung in this far with me, huh? Chapter 9. You can tell I kind of like this information. Chapter 8, rather. The asset cost us $60 million. At the end of 4 years, we had depreciated 11.4, meaning that's the balance in the accumulated depreciation account, the contra. So the remaining book value is $48 million. That's the history. We know that now. But now we're saying we're not going to get $3 million at it. We're only going to get $2.4 million. So we subtract that to get the new depreciable base. 46,200,000. We had this machine for 4 years and we were depreciating it for 20 years, but that has changed. We changed it to a 25-year machine. We have to take 25 life minus the 4, meaning we're going to take this new depreciable balance, divide it by 21 to get the annual depreciation expense. You think that was enough for one class? I do. And I have to confess, I had the UCLA game on here, and they were playing. They were in a tough game with Oregon, and UCLA got down to about the 10-yard line. It looked like needing a field goal to tie the game in the last few seconds. And I got so absorbed in our lesson here, I look up and the game's over, and I don't know what happened. I presume UCLA lost because they'd be in overtime if they had kicked the field goal. I digress. Hey, you have a good remaining weekend. And one of these days, pop in just to say hi. I'd like to see at least a couple of the faces of my class, for Pete's sake. You're looking at my mug all the time. It seems unfair. Okay? You take care. And by the way, the New York Jets, tomorrow might be their only chance to win a game this year. My New York Jets have not won a game all year. Tomorrow they play at the Chargers, so we'll see. Okay, bye-bye.